Uh, yeah, day 7 of the series. Today we'll be doing question number 13 onwards. We only have 20 minutes today, so let's begin. Question 13 is give an example of three financial intermediaries and explain how they act as a bridge between small investors and large capital markets or corporations. So we have to give examples of three financial intermediaries and explain how they act as a bridge between small investors and large capital markets or corporations. So three examples are, first is banks. So function of banks is that banks collect deposits from individuals and small investors, pooling these funds to provide loans to large corporations, businesses and governments. And bridge role is that small investors benefit by earning interest on their deposits, while banks use these funds to make large loans to corporations, facilitating business operations and expansion. Banks thus act as a bridge by transforming small, liquid deposits into substantial financing for larger projects and corporate needs. Second example is the mutual funds. So mutual funds function is mutual funds pool money from numerous small investors to buy a diversified portfolio of stocks, bonds, or other securities in the capital markets. Bridge role, small investors gain access to professionally managed diversified portfolios, often including stocks or bonds from large companies they might not be able to buy individually. This lowers investment risk for individuals while giving corporations access to capital markets through pooled investments. Third example is insurance companies. Function: insurance companies collect premiums from policyholders, pooling these funds to invest in large stable assets like government bonds, corporate bonds, and real estate. Bridge role: while individuals receive financial protection, example life or health insurance, the premiums are invested in markets that support corporate finance and large scale infrastructure projects. This allows small premiums to contribute indirectly to broader economic development and corporate funding. Each of these intermediaries enables small investors to participate in the broader financial ecosystem, providing indirect access to large scale investments and supporting corporate financing. So that's question 13. Question 14 is the average rate of return in investments in large stocks as measured by return on Sensex has outpaced that on investments in G-SECs, government sectors, by about 10% since 1917 India. Then why does anybody invest in government sector? So basically it's asking if since like for 55 years now, if the equity market has consistently generated a return that is 10% better than the return from government securities, then the question is why would anybody knowing that fact willingly invest in government securities? So the answer is, despite lower average returns, investors still choose government securities, GSECs, over large stocks for several key reasons. First is lower risk. Government securities are backed by the government, making them one of the safest investments available. While stocks can be volatile and subject to market fluctuations, government securities provide stability and are considered virtually risk-free, appealing to risk-averse investors. Two is stable income. Government securities offer fixed, predictable interest payments, which can be attractive to those seeking a reliable income stream like retirees. Stocks, on the other hand, can have variable dividends and may not pay out if the company underperforms. Third is diversification. Many investors include government securities in their portfolios to balance out the higher risk associated with stocks. Diversification reduces the overall risk and volatility of a portfolio, providing a safety net against market downturns. Fourth, liquidity and market access. Government securities are highly liquid, and some investors may use them for short-term parking of funds while maintaining easy access to capital. They are also accessible to a wide range of investors, including individuals, mutual funds, and banks. Fifth is regulatory requirements. Institutional investors, such as banks and insurance companies, are often by regulation required to hold a certain percentage of their assets in government securities to ensure liquidity and stability in the financial system. While stocks offer higher returns on average, The safety, predictability, and regulatory advantages of government securities ensure they remain an essential part of many investment portfolios. 15th question is, what are some advantages and disadvantages of top down versus bottom up investing styles? So let's talk about top down investing first. So, top down investing's advantages are: number one, broad economic insight. This approach starts with an analysis of macroeconomic factors, example, global trends, interest rates, industry performance, giving investors a big picture view that can reveal sectors likely to grow. Second point is sector and trend focused. By identifying promising sectors or regions first, investors can target areas with favorable economic conditions, potentially capturing growth driven by overall market trends. Third, diversification across sectors. Since top down investors often select multiple sectors or industries, this approach tends to provide a more diversified portfolio. Disadvantages include less focus on individual companies. Top down investors may miss critical details about specific companies with selected sectors, potentially overlooking risks or mismanagement at company level. Second is dependence on accurate economic predictions. This approach relies heavily on the accurate forecasting of economic trends, which is challenging and can lead to missteps if predictions are off. Third point is sector rotation risk. Quickly shifting from one sector to another based on trends may lead to frequent portfolio adjustments, increasing transaction costs and potentially tax liabilities. Now we talk about bottom up investing style. So the advantages for bottom up investing are: number one, focus on company fundamentals. Bottom up investors analyze individual companies, examining factors like financial health, competitive position, and management quality. This can lead to a more informed company specific investment decision. Second point is potential for long term gains. Since this approach often involves picking solid, fundamentally strong companies, it's well suited for long term investing and compounding returns. Third, less dependent on economic cycles. Bottom up investors can find value even in a weak economy as they focus on companies with unique growth drivers or resilience, regardless of market conditions. Disadvantages include time intensive research. Analyzing individual companies requires extensive research, which can be time consuming and challenging for those with limited resources or experience. Narrow perspective. This approach may lead to overlooking broader economic factors or sector trends that could impact the performance of chosen companies. Third point is sector concentration risk. If a bottom up investor focuses heavily on certain companies within one industry, it could lead to concentrated risk, especially if the sector faces unexpected challenges. Um, so that was question number 15. Question number 16 is, you see an ad for a book that claims to show you how you can make rupees 1 million with no risk and with no money down. Will you buy the book? No, I will not buy the book since it's one of those get rich quick schemes which never really work, because if they did, and if there was actually a chance slash strategy to make a lot of money with absolutely no risk, then nobody would tell anybody else that method and they wouldn't even think about publishing it, and instead just make as much money as they can before the gold mine runs out, hypothetically. Therefore, we should never get enticed by these schemes and traps, since there's no such thing as no risk or high reward, and high reward actually. So that's question number 16, basically saying that don't believe in get rich quick schemes because they're 99.9% of the times scams. So 17th question is, why do financial assets show up as a component of household wealth but not of national wealth? Why do financial assets still matter for the material well-being of an economy? Financial assets are counted as part of household wealth but not national wealth due to differences in how these concepts measure economic value. One second. Yeah. So we're basically asking why financial assets show up as a component of household wealth but not of national wealth, and also why do they still matter for the material well-being of the economy? So financial assets are counted as part of household wealth but not national wealth due to differences in how these concepts measure economic value. First point is household wealth. For household, financial assets like stocks, bonds, and bank deposits represent personal claims on income or capital and contribute to individual wealth. When a household holds a financial asset, it owns a claim on either uh, another household, a business, or the government. Thus, these assets add to the household's wealth because they can be used to generate income or provide financial security. National wealth. National wealth, however, only includes real assets like land, building, factories, and natural resources that contribute directly to a country's productive capacity. Since financial assets are essentially claims on these real assets or income flows within the economy, they don't increase national wealth on their own. They simply represent ownership of real assets. Counting financial assets would double count the value of the underlying real assets they represent. Why financial assets still matter for the economy's material well being. Despite not being part of national wealth, financial assets play a critical role in economic well being. Facilitating investment, financial assets allow capital to flow from savers to businesses and projects in need of funding. This flow is essential for investment in infrastructure, technology, and innovation, which drives economic growth and productivity. Liquidity and risk management. Financial markets give individuals and firms the ability to convert assets to cash and manage financial risk. Households can invest in diversified portfolios to secure future income, and businesses can raise funds through stocks and bonds. Economic stability. Financial assets enable the central bank and government to influence the economy through monetary policy, example, controlling interest rates and fiscal policies. A well functioning financial system helps stabilize the economy, which benefits material well being by maintaining employment and reducing inflation. So, while financial assets aren't counted in national wealth, they're essential for mobilizing resources, supporting investment, and managing risks, all of which contribute to the economy's overall health and growth. So, that was question number 17. We actually only have two more questions, so we'll just knock them out real quick. And then, I actually haven't done these questions in the Google Doc. I haven't done these questions. So, yeah, let me check if I have done these questions. Okay, I haven't done these questions. It doesn't look like it. Maybe I have one. Yeah, okay, I haven't done the last two questions. So, 1 second. Yeah, 18th question is Wall Street firms have traditionally compensated their traders with a share of the trading profits that they generated. How might this practice affect traders' willingness to assume risk? What is the agency problem this practice engendered? So this practice, this practice affects the traders' willingness to assume risk since their income depends on the profitability of those trades, and therefore if they are in a good position, then they won't be taking any more risks and further damaging the chances of having a good income and thus become more risk averse, which might not be a good thing since these firms value or no, prioritize maximizing shareholder value, shareholder wealth, and therefore if a trader is holding back on a trade because he is worried about his salary or commission, then that negatively affects the firm's ability to produce profits for the shareholders. So that's part one. Part two of the question is, what is the agency problem this practice engendered? The agency problem that is caused is that by tying the traders compensation with the profits they generate for the firm, they have made them likely to be overly risk averse and careful, which might harm the firm. On the other hand, it might also motivate the traders to work harder and earn more, since they will directly benefit from it. I think that's like roughly the answer for that question. And now answer 19. Answer 19 is, what reforms to the financial system might reduce its exposure to systemic risk? So reforms to the financial system might reduce its exposure to systemic risk. I'll have to check this one actually. I do not know. It's a very big question. So ChatGPT is giving me point number one: strengthening capital and liquidity requirements, higher capital adequacy ratios. Okay, so basically saying that firms should not be as leveraged as they were before 2008. Especially Lehman Brothers, it was, I think, leveraged like 16 times, maybe even more than that, if I'm remembering it incorrectly. So, yeah, liquidity coverage ratio, net stable funding ratio. I don't know all these ratios right now. So, yeah, basically, more regulation, supervision on the loans, and who they're giving those loans out to, making sure the default rate isn't that high. So yeah, that's pretty much it. I'll tell it to make a short answer, not bold, hyphen, and then I'll copy paste that into the doc. So the final answer is reforms to reduce systemic risk aim to make the financial system more resilient and less interconnected. Stronger capital and liquidity requirements ensure banks can absorb losses and meet short-term obligations, reducing the chance of collapse. Central clearing of derivatives and limits on large exposures helps contain contagion between institutions. To address the too big to fail, the quote-unquote too big to fail, regulators require resolution plans and can wind down failing banks without bailouts. Separating retail and investment banking further protects depositors from trading risks. Macro prudential tools such as counter cyclical capital buffers and higher requirements for systemically important banks help curb excessive risk during booms. Greater transparency through disclosure and stress tests allow earlier detection of weakness, while tighter oversight of shadow banking reduces risk outside traditional regulation. Coordinated supervision and improved governance strengthen the overall stability of the financial system. So that's the final answer, and that's it for today. We are down with the 19 questions. Pretty happy with the pace. We finished it in 3 sessions. And yeah, thanks for watching.